Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Amicus Therapeutics Inc. annual report. Amicus Therapeutics, a biotechnology company, specializes in developing novel medicines for rare diseases globally. The company's product portfolio includes Galafold, an oral treatment for Fabry disease, and Pombiliti plus Opfolda, a two-component program for late-onset Pompe disease. Through its collaboration with GlaxoSmithKline, Amicus Therapeutics is also working to develop and commercialize Galafold. The company's focus on rare diseases has led to the development of innovative treatments that cater to specific patient needs. By providing these specialized medicines, Amicus Therapeutics aims to improve the lives of individuals affected by these conditions. With its headquarters in Princeton, New Jersey, the company continues to advance its research and development efforts to bring new hope to patients worldwide. The list of businesses and services provided by Amicus Therapeutics includes developing novel medicines for rare diseases, commercializing Galafold for Fabry disease treatment, collaborating with GlaxoSmithKline on Galafold's development and commercialization, creating Pombiliti plus Opfolda, a two-component program for late-onset Pompe disease. Overall, Amicus Therapeutics is committed to delivering innovative treatments that address the unique needs of patients with rare diseases. Amicus Therapeutics Inc. Fold has experienced a significant surge in its stock price over the past year, increasing by over 53.53%. This substantial appreciation can be attributed to two primary factors: the proposed acquisition by BioMarin Therapeutics and the company's robust financial performance. The proposed acquisition by BioMarin Therapeutics was a major catalyst for the increase in Amicus Therapeutics' stock price. In December 2025, the company entered into a definitive agreement with BioMarin Therapeutics to be acquired for $14.50 per share in an all-cash transaction valued at approximately $4.8 billion. This fixed acquisition price provided a clear upward trajectory for the stock as it traded towards the takeout value. In addition to the proposed acquisition, Amicus Therapeutics' strong financial performance also contributed significantly to its increased stock price. The company announced impressive full-year 2025 financial results, with total revenues reaching $634.2 million and demonstrating a 17% operational growth year-over-year at constant exchange rates. This strong performance was driven by significant sales of the company's key products, including Galafold and Pombiliti plus Opfolda. The improved financial health of Amicus Therapeutics also played a crucial role in its increased stock price. The company's cash equivalents, and marketable securities increased to $293.5 million by December 31, 2025, marking a $44 million increase during the year. This enhanced financial position further bolstered investor confidence, contributing to the substantial appreciation in Amicus Therapeutics' stock price. Overall, the proposed acquisition by BioMarin Therapeutics and Amicus Therapeutics' robust financial performance have been the primary drivers of its increased stock price over the past year. Amicus Therapeutics, Inc. maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Amicus Therapeutics, Inc. trades at a higher price-to-book ratio of 19.2 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 75% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, the approval and commercialization of new products such as Galafold in over 40 countries and Pombiliti plus Opfolda in several key markets have been significant contributors. Additionally, exclusive license agreements like the one with Dimerix offer potential for substantial revenue through commercial milestones and royalties. Business development opportunities, including collaborations, partnerships, or acquisitions, also present a pathway to revenue growth. Conversely, factors such as loss of market exclusivity due to non-exclusive licenses or patent litigation can lead to revenue decline. Intellectual property disputes surrounding patent validity and enforceability further contribute to uncertainty in revenue growth. Other key factors that impact revenue growth or decline include fluctuations in foreign currency exchange rates, regulatory changes, and the success of clinical trials for new product candidates. The geographic breakdown reveals growth in U.S. revenue from Galafold sales and Pombiliti plus Opfolda sales, as well as international markets. Overall, a company's ability to navigate these factors will determine its trajectory towards revenue growth or decline. The net income of a company has undergone significant changes over the past few years. Initially, it decreased due to reduced reimbursement from government programs and potential implementation of healthcare reform measures. However, in 2024, the net income increased by $105,915,000 compared to 2023, and this trend continued into 2025 with another increase of $105,915,000. Notably, the net income turned positive in the second half of 2025. The profit margins have also experienced a decline due to various factors such as downward pressure on prices from healthcare reform measures, increased competition, and reliance on third-party manufacturers. The implementation of the Inflation Reduction Act's drug price negotiation program is expected to further impact profit margins negatively. As a result, the profit margins declined in 2025 compared to 2024, indicating a challenging business environment for the company. The company's financial performance is a testament to its ability to generate significant operating cash flow. According to the provided information, the company generated $33.1 million in positive operating cash flow in 2025. This is further reinforced by the fact that net cash provided by operating activities was also $33,145 in the same year. The Chief Financial Officer's statement on page 142 adds credibility to this assertion, confirming that the company achieved positive net cash from operating activities in financial year 2025. These figures and statements collectively demonstrate that the company is indeed generating positive operating cash flow, a crucial indicator of its financial health and stability. The company's debt level has experienced significant changes over the past year. Initially, there was a notable increase in debt with the entry into a new senior secured term loan due 2029. This led to an overall rise in long-term debt from $390,111 in 2024 to $392,660 in 2025, representing an increase of $2,549. In contrast, interest expenses have shown a decline. The company's interest expense decreased by $3,439,000 from -$49,598,000 in 2024 to -$46,159,000 in 2025. Furthermore, the net interest expenses as a percentage of net product sales also decreased from -9.3% in 2024 to -7.3% in 2025. The decrease in interest expenses is notable, despite the increase in debt level. This suggests that the company has managed its debt effectively and has secured more favorable terms on its new loan. The reduction in net interest expenses as a percentage of net product sales indicates improved financial efficiency for the company. The recent market analysis reveals a concerning trend for international markets. According to the extracted summaries, these regions have performed poorly, as indicated on pages 4 and 47 of the report. In contrast, there is no specific mention of the U.S. market's performance, although it is noted that DMX-200 has licensed rights in this region. This lack of information suggests that the U.S. market may be performing adequately or even well, but further analysis is needed to confirm this assumption. The management is optimistic about the company's outlook, emphasizing its commitment to driving growth through innovation. The company expects significant costs in research and development expenses, but sees this as a necessary investment for long-term success. To achieve this goal, it aims to successfully commercialize its products globally, expand its business through collaborations and acquisitions, and protect its intellectual property. The management is also focused on fostering an ownership culture among executives, tying their compensation to corporate goals and individual performance. This approach is designed to align the interests of executives with those of shareholders, promoting a shared commitment to maximizing stockholder value. Overall, the company's strategy appears to be centered on driving growth through innovation, commercialization, and strategic partnerships. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company merged with BioMarin under undisclosed terms and also acquired businesses without specifying the amount involved. On the other hand, the company has entered into various license agreements to divest its interests in certain products. It granted non-exclusive licenses to Teva Pharmaceuticals USA, Inc., Aurobindo Pharma Limited, and Lupin Limited to market generic versions of Galafold. The terms of these agreements are similar to those with Teva, which was announced earlier. These moves suggest that the company is focusing on expanding its product offerings while also managing its intellectual property rights. The company's financial strategy has been focused on returning value to its shareholders through share repurchases rather than dividend payments. According to the provided information, in one notable instance, the company bought back a total of 20,767 shares at an average cost of $8.35 per share. This indicates that the company is committed to utilizing its resources to enhance shareholder wealth by reducing the number of outstanding shares on the market. The company's growth plans are being hindered by concerns about inventory buildup and supply chain disruption. One major concern is inventory buildup, with projected costs reaching $1,890,000 in 2025. The company has already seen a significant increase in inventory levels, rising by $111.5 million in 2025 and $73.7 million in 2024. The company's reliance on third-party distribution arrangements and marketing alliances also poses a risk of supply chain disruption. This includes the potential for distributors to experience financial difficulties or compliance-related issues. Furthermore, there are concerns about the quality of materials necessary for clinical trials, as well as potential delays in production due to manufacturing issues. Additionally, the company faces risks related to international trade, including tariffs, sanctions, and other measures that can restrict trade and disrupt its supply chain. These factors could lead to delays in obtaining marketing approvals or insufficient quantities of products, ultimately impacting the company's growth plans. That concludes the financial summary for Amicus Therapeutics Inc. Feel free to comment below, and I will be happy to answer them when possible.